Alex Detter, class of 2015. I have the distinct pleasure of introducing our next guest, Matt Harris. So on this episode of Williams Summit, we have Matt Harris, class of 1994. Matt is a partner at Bain Capital Ventures based in New York City, where he spends his time evaluating investment opportunities in financial technology and services. Matt began his career at Bain & Co. as a consultant before moving to Bain Capital Private Equity. After working in private equity, Matt co-founded Village Ventures with another Eve, where he ran the firm for 12 years, focusing on early-stage fintech investing. In 2012, he rejoined Bain at Bain Capital Ventures and has since invested in companies like Acorns, Flywire, OpenFin, Ribbon, and Billtrust, to name a few. Outside of his work, Matt enjoys spending time with his wife, Jessica, and their 6 children. So that's quite a background. You've clearly accomplished so much in your career thus far. Can you bring us back to the beginning, to a younger Matt fresh out of college? What led you to Bain & Co. and into the world of investing as a whole?
Sure, yeah, well, and thanks to you both for having me. It's an honor to be able to speak to the Williams community. So I went to college, like you two gentlemen, pre-med, the son of 2 doctors. I assume that was just what one did, but I think it was organic chemistry that washed me out of the program. I'm not sure what did it for you guys.
Same. Yeah.
So I ended up a political economy major, and in my sophomore year, I took a class that was an elective that there's this visiting professor who was otherwise a consultant, and he led this class and taught some case studies from Harvard Business School that were, if you're familiar with that format, they really sort of walk you through a business problem and ask you to use various analytical tools to kind of come up with an answer. And I just thought that was awesome. I was like, wow, this is so engaging, and more so, I think, than most of the other classes I was taking at the time, certainly more than the pre-med stuff. So that set me on a path to, as far as I knew, that meant that consulting was going to be my life's work, because that's what I found that passion for. And so I literally looked through the yellow pages for consulting firms, applied and got a summer job at a tiny firm that was just getting started. A couple of Bain partners started a firm called Lucas McPhee. Doesn't exist anymore, but anyway, it was basically Lucas and McPhee starting this thing, and I was, free summer help for them. And so I did that for 2 summers and confirmed for me anyway, that solving business problems was what I was good at, what I enjoyed, what I was passionate about. It certainly wasn't going to save the world, unfortunately. But, I do think if you find something that you really feel like you've got your swing, it's worth leaning into that. So I also met a guy along the way, a guy named Bob White, friend of a friend. He was a friend of one of the founders of this consulting firm, and Bob was a partner at Bain Capital. Bain Capital at the time was a 20-person company based in Boston doing private equity, and it had spun out from Bain & Company about 10 years prior. And so I talked to Bob, and he was like, look, basically explained to me that private equity was like consulting, except you owned the client. And so you kind of got to be a little more forceful about your recommendations. And also you benefited from the results because you had an equity stake. And so that seemed like the perfect situation. So I decided to apply primarily to Bain & Company out of Williams. I applied to McKinsey and BCG as well, but Bain was really, felt to me somewhat naively that would be an on-ramp to Bain Capital, which is where I had set my sights. And so I did get the job at Bain, started in the Boston office, and had a great experience there, sort of through the luck of the assignments I got. I ended up working with a lot of the women who ran Bain at the time, Arit Kadish. And so a year in, my boss left to go to another private equity firm called Summit, and he made me an offer to come with him. And it was sort of taboo to leave one of these places after just a year. So I went to Arit, who ran the firm, and I said, I have this situation. I want to do private equity. That's what my whole goal was. And it sort of is an opportunity now, a year in, but I don't want to do anything that'll make you unhappy or the firm unhappy. And she was very gracious about it. And she called the folks at Bain Capital and said, "Oh, we got a good guy here who's regionally good, and he's leaving to do private equity. Might as well come to your shop." So she kind of smoothed the path, and I ended up at Bain Capital, a year out of college, which was, in some ways kind of I could imagine a second year of Bain and Company would have helped me a lot. I mean, I just landed there. There's no training. It was like, here's a computer and Excel and figure out how to do leverage buyout models, which I had no idea how to do. So it was trial by fire, but a good experience. Ultimately, again, back then, Bain Capital was small, and it was run by this guy, Mitt Romney, who, it doesn't align with my politics particularly, but it was a great leader, a great mentor to me back in those days. And so we did some interesting stuff. But ultimately, the sort of like son of doctors thing caught up with me, and private equity, at least back in those days, the playbook was very much about reducing cost. You might then help a company grow, and certainly we did that. But on day one, it was generally sort of like, let's see if we can cut the headcount here by around 10%. And so a lot of that work fell to folks like me. So I was this, 22, 23-year-old guy looking at spreadsheets with people's names on them, and thinking about who wasn't going to have a job after we bought the company. And that wasn't, felt like not what I was put on earth to do. So I, around the time I was having this sort of crisis, I got a call from Williams College, who, this is 1996. And in 1996, the internet was just sort of starting to be a thing. And my college roommate, a guy named Bo Peabody, my best friend, he had started a company during college, and all of us, pitched in and contributed. I think I was a vice president of something or other. Well, I was an undergraduate, but it was really his company, and he had made a big success of it. So this company called Tripod had about 70 employees in Williamstown, which, as you'll know, is a big deal in Williamstown. And they were employing, the spouses of faculty, and kids would graduate and go work at Tripod and get tech experience and internet experience. And college was like, this is great. How do we do more of this? So they found me, and basically it worked out that they put up $500,000 into a fund. And I agreed to come out and be the manager of that fund. And I was.
This is at what age was this?
I was just turning 24.
Wow.
Yeah. So not a great decision by Williams College. I mean, I was in no way qualified to run this fund. And I had never done venture capital, for one thing, right? I mean, private equity is totally different than venture capital, and it was not, obvious that a town of 6,000 people needed a venture capital firm, or that there was a valid business plan, or that $500,000 was a reasonable amount of money to invest out of a venture capital fund. So lots of problems, but I was sort of like, what do I have to lose? Like at very least, I'm going to create some jobs in the Northern Berkshires, which desperately need them. I can kind of cleanse my soul of this private equity thing. And, but, it all worked out. We ended up raising $20 million, we being like me and my golden retriever. And I loved living in this small town again. It was great. And we invested in a bunch of internet companies. And the late 90s, like, you just invested in an internet company, it just worked. So we had these great returns for a period of time. And by 1999, so 2 years later, I was on the cover of the Wall Street Journal, this article about, this investing strategy in these small kind of tertiary geographies. And it really went to my head. I mean, I was like, I've got this figured out. Turns out I'm a genius. And so Bo sold Tripod for a ton of money, and he and I decided we were going to take this model of sort of investing in college towns and smaller cities, and we were going to make that a national platform. We were going to started a firm called Village Ventures, and it was kind of a hub and spoke thing where we set out a business plan to create firms and funds across the country, across the world, ultimately, and we would provide sort of centralized support and scale, And then we would sort of cherry pick the best deals that they found and co-invest alongside them. So we built this incredibly well thought out strategy and plan. We raised $100 million in, I'm now 27 at this point, in the first quarter of 2000 from Bain Capital and Highland Capital and a bunch of smart investors. And then the world totally fell apart. The first
That's
of
familiar.
Yeah, right, exactly. This is my third global crisis that I've lived through. That was the first one, and I was not prepared at all. And yet we had the money. We had raised it. We gave some of it back, and we really had to revisit our plans quite dramatically. We had to skinny everything down and rethink our priorities and focus on the few things that we thought could make work extremely well versus this incredibly vast, intricate strategy that was going to be hard to execute. And one of the things I did was, I had found venture capital incredibly easy because it was, 97 to 2000, just frankly was easy. But I had to really think about if I'm going to spend a career doing this, how am I going to be a leader? And for me, I basically decided, I had to be focused on an area that was underserved. I had to pick a part of the venture industry where not a lot of people were playing, and I had to become the leading expert in that. And because I'm not really a great salesman, I'm not an extroverted guy. Like, put me in a cocktail party, you'll find me hiding in a corner 10 minutes later. I'm not the life of anybody's party. So, the only way that I can effectively win deals and feel confident is when I really know what I'm talking about. So for me, that became what we now call fintech. But at the time was really just sort of innovation in financial services. This is 20 years ago, and nobody was doing financial services and venture capital. It was like the null set. And but yet I saw all these payments companies and lending companies and asset management, wealth management, insurance, all those industries are based on information, data, technology, and felt like there was room for entrepreneurs to really be disruptive. So I decided I was going to make that my life's work. I was going to go to school, metaphorically on those segments. I was going to be the smartest guy in the venture industry about everything to do with financial services. And even if it never became a big thing, I would at least be the leader in it. So that's what I spent the next decade doing. It was incredibly hard. It was really not rewarding. I mean, it remained obscure for a lot longer than I enjoyed. My wife would always say, like, what, maybe don't talk about your work so much. I don't think people really are that interested. So, and then it just exploded. Fintech is now close to 20% of the venture business. And I happen to be the only one really who's done it for 20 years. And so when that happened, it made sense for me to come back to, a bigger firm to where I could have a larger impact. And so at the end of what ultimately was our final fund at VV, Bo and I wound the firm down, and I came back to Bain Capital and really launched the fintech practice for the firm. And that's what I've done for the last 8 years.
Very cool. Well, that was really cool. Incredible. I think you took off three of my 5 questions, so I really appreciate that. Yeah. I did want to kind of center in on one, which I think is something we don't get a lot of experience that much to, is at Williams, is kind of being an entrepreneur. And so, as you kind of think about, A, you were relatively young when you founded Village Ventures, and 2, coming from a liberal arts background, there aren't necessarily entrepreneurial classes that we can take to kind of prepare ourselves. So how did you think about kind of making that step to being an entrepreneur, subsequently investing in other entrepreneurs? And then how do you think about the Williams, background and training, how that prepared you to be an entrepreneur?
Well, as I go back to this 24-year-old version of myself, because that to me, I think was the real entrepreneurial leap, was leaving Bain Capital, which was, well-paying and very secure, and also branded, right? Like everyone knew increasingly over the course of the 90s, knew what Bain Capital was. It was prestigious. And leaving that to start my own firm in such a rinky-dink way, it was a period of time when a lot of my friends were starting companies. Bo obviously had done so in school. Another very close friend and roommate, Mike Seckler, and John Allberg had teamed up to start another company. And I found that inspiring and kind of like challenging a little bit. Like, entrepreneurship is a really noble thing. You build a company, you employ people, you create progress in the economy. And I sort of had this, not, again, I was having this crisis on one hand about, did I want to do private equity? But on the other hand, this existential question of, am I an entrepreneur? I mean, do I really have what it takes? So I had to answer that question for myself. And I found a way to do it that, again, the failure case was not disastrous. If it didn't work out, it would have made a good business school essay. And then Village Ventures was a sort of logical next step. I had convinced myself that I was reasonably good at this entrepreneurial thing, that frankly, the liberal arts background was the perfect background. Like, you could argue that a technical background to where you can like code things and build things is important in entrepreneurship. But actually, frankly, those are skills that you can recruit for. What you need is a nimble mind, an ability to think in analogies and ability to see around corners. And frankly, I found that my Williams education suited me very well for that. So I felt like I had the intellectual toolkit. I felt like I had proven, that I had the sort of grit, because, a lot of the entrepreneurial experience is people saying no to you, and finding that your theories seem implausible to most of the world. And so you really have to have both adaptability to revisit your theses, but also the backbone to follow through with something that seems unlikely, implausible, unpopular. So that all, I think, felt right. I think the decision to leave Village Ventures to go back to Bain Capital, though, reflected a more nuanced perspective, which is that I think I was reasonably good at being an entrepreneur. I think I am entrepreneurial. But I know what a real entrepreneur looks like. A real entrepreneur is like my best friend Bo, who I mentioned. Like, Bo is not gonna work for anybody else. Like, his frame of mind is such that the creativity that he has, the flexibility that he requires to pursue the paths that he thinks are the right paths, the resistance he has to things that impede him in those pursuits. That's often what defines a, like, quote, real entrepreneur from someone like myself, who is plenty entrepreneurial. To me, my decision was governed by what's the best platform where I can be the best investor I want to be, even if that means leaving an entrepreneurially founded firm that I was running. I view myself as somebody who will toggle back and forth between entrepreneurial firms and larger firms. I'm incredibly happy at Bain Capital now. I think figuring out where you are in that continuum is a really important part of your 20s, frankly.
I guess switching gears a bit, we wanted to talk a little bit about fintech specifically, as like this, as you mentioned, is kind of your sweet spot. We've seen a lot of movement in the industry. Do you mind sharing a little bit of the most interesting trends you've seen in the sector?
No, not at all. I mean, I think so I've lived through a couple of decades of fintech. The first was largely around, I would say, payments innovation. The companies that were really built in that first decade, you think about Stripe and Square and PayPal. Payments was very much the first segment of financial services to be digitized and to where entrepreneurs could kind of take market share away from incumbents. This last decade, which I think to me sort of has come to an end and we're onto a new phase, which I'll discuss, was about taking products that we all use and making them mobile and digital. So taking a bank account, transforming it from a paper-based branch-based experience into an app-based, web-based experience, taking renters insurance and homeowners insurance and auto insurance, taking wealth management and asset management, taking lending, student lending, personal lending, mortgages, taking all those things that exist and have existed and transforming them to experiences that are more digital in nature and more modern. And what we found was that the incumbents, the banks, the insurance carriers and brokers, were very slow to move in this regard and did not have the culture or the tech talent to kind of disrupt themselves. And so there was a lot of room for entrepreneurs to not fundamentally transform these products, but just make them modern and make them digital. And those companies took a lot of share. And I think that era is sort of over. I think the incumbents have sort of more or less entirely figured it out. I mean, my app from Chase is incredibly good. I mean, it is, if you want to just get banking done, like go get the B of A app or the Chase app, it works perfectly fine. By the way, like if you do need a branch once in a while, like they have branches and, you know, Chime doesn't. So I think the sort of heads up competition of let's take standard products and make them digital. I actually think the incumbents have a fair chance to hold steady on market share, if not win back market share. I think they have reacted appropriately, and it's not to take anything away from Chime or Robinhood or Lemonade or any of these companies. I think they've built sufficient scale to be valuable companies. But what we're really looking for now is truly software companies who build distinctive value propositions that embed financial services within them versus people just yelling, hey, open a bank account with me. So you mentioned Acorns. I view Acorns as sort of an early version of this. You know, Acorns started life as really not a bank account. It started life as a savings app, a set of digital tools and content to help people save more money, leveraging behavioral finance to make it painless. And we found that the average person would save $400 or $500 a year. And we invest that in the market for them and at whatever risk tolerance they tell us they have. And so we've got 7 million people who've got, you know, on average north of $1,000, and that's more than the average American for sure. And these folks tend to start with close to zero savings when they start working with Acorns. And so it's building a software-driven experience which provides value to consumers in this case, but the same logic holds true for business customers. And then layering in financial products. So, you know, you can now bank with Acorns. You can get a debit card from them. You can use it at any ATM. You can treat it as either your primary bank account with no other bank account, or you can treat it as a companion bank account. You can keep your Bank of America account, but use your Acorns card and your Acorns app for your spending and your budgeting and et cetera. You can also get insurance through Acorns. So we think the future of fintech, the next decade plus, is about these software-driven experiences which create new value for consumers and businesses, and where payments and lending and insurance and banking are foundational components, ingredients, but not the business into itself.
Got it. And so I think you touched on a number of really important aspects there. So as you kind of think about incumbents in like the JP Morgans of the world, you know, obviously the smaller players like Acorns, they are, you know, presenting a new value proposition, but given they're much smaller, you know, JP Morgan is one of the, you know, arguably the largest bank in America. Can they just flip on a switch and provide the same kind of software experience that Acorns has? You know, you've seen, you know, Acorns, you've seen SoFi kind of start with one niche and kind of expand and kind of broaden out into the financial ecosystem. How, I guess, how deep are those moats compared to a larger player like a Charles Schwab or a JP Morgan who can, you know, have an army of developers kind of deliver the same experience?
Well, I'm probably, relative to my peers, more bullish on the incumbents than most. I think that Schwab and JP Morgan and Bank of America are well-run companies. And I think they're going to build, they have built, as mentioned, you know, perfectly sufficient and even in certain ways delightful products And so I would contrast Acorns and SoFi as these two different types of competitors. SoFi is not a software company. Now they just bought a software company, as it turns out, but they're a lending company. Their product is a loan. Acorn's product is a software app. You might, and you will soon be able to get a loan through Acorns, but that is very different than SoFi, who literally buy Super Bowl ads that say, come here and we will lend you money. I think that's a very FinTech 1.0 company to me that is highly vulnerable to JP Morgan Chase saying to their 30 million customers, you know what, we actually have a loan that looks just like that SoFi loan. In fact, it's much better because our cost of capital is like 0. And SoFi is not a bank and has a much higher cost of capital. So a standalone lender like SoFi, I think, has very little in the way of moats relative to incumbent competitors, because what they're selling is a product that can be easily, in fact, better manufactured by an incumbent. Now, it's taken the incumbents a while, but they have caught up with these straightforward, off-the-shelf type products. JP Morgan's challenge in creating Acorns, I think, is more substantial. I think theoretically, X number of developers and Y budget and Z time can do anything theoretically, but in fact, design and creativity and innovation can't be captured by those simple inputs. And so, like Bank of America invented the roundup 15 years ago, this idea that you would pay for something and then they would round to $1 and that incremental pennies would get put into a savings account. That's very similar to what Acorns does. Again, it was invented by Bank of America 15 years ago, but they did not build it in beautiful software that has many, many layers of functionality and is a constantly moving goal line, keeping competitors always at a distance. So at Acorns, we worry a lot about our other technology-driven, entrepreneurial-led competitors like Stash and Chime and Aspiration, some of whom have the same theory of the case, that it's about building deep relationships through software. We generally don't worry that much about our incumbent competitors who are spending a lot of time making their products digital, but have shown no ability so far to get beyond the idea of products into the idea of software-driven innovation, deep relationships through elegant, non-product oriented software. I think the one relationship that I think is really interesting to me is Goldman and Apple. So that's, Goldman took, I don't think Goldman sat around thinking, yeah, we can build an app-driven credit card that will be so distinctive and so elegant and so deeply integrated into people's other payments experiences and app experiences that we will get 12 million cardholders in 2 years to use the Goldman credit card. They thoughtfully said, you know who can do that? Apple can do that. Actually, a company known for building beautiful software who actually has a deep relationship with 60 million consumers is better positioned to do that than us. And so we can be the intel inside and empower them to build that.
Do you see like the large FI, like financial institution and large tech company trend being a thing, or is it like more of just like a beautiful, unique combination?
I think it is going to be a thing. I think, JPMC and B of A and Citi need to think hard about whether they want to be just the dumb pipes. And that's sort of like a overtly pejorative way to put it. Like Amazon will get into banking.
Gotcha.
And, when they do, they will take a lot of market share. And some bank has got to decide if they want to be the intel inside for Amazon. And it's a hard decision because Amazon's going to take customers away from JPMC.
So I guess like quickly turning to payments, when I studied abroad this past fall, and like I think a lot of people that did were really amazed by the whole tap feature. Yeah. And so I guess I kind of saw it as like an analogy for like the greater competition between payments in the US and payments outside. And so I was wondering, like, obviously, like US is in many ways the birthplace of technological innovation. But are there moments where we feel behind, and why is that?
Yeah, I think in payments we are definitely behind. I think I would say the leading geography for payments innovation is East Africa. I mean, and then followed quickly by China and Southeast Asia. Generally, what you've seen is what economists call a leapfrog phenomena, where U.S. payments infrastructure was good enough, and it still is good enough. We got chips in our cards, later than everybody else. We got them. We have contactless tap payments. It's rolling out slowly. I think the pandemic will actually hasten that along. But the fact is, we had sufficiently suitable payment methods that nobody thought were dramatically broken. But if you look at Kenya and if you look at China, they had cash-based economies that were not efficient or incredibly expensive. And so they were able to introduce payment methods that were more modern than ours and see rapid uptake and adoption, simply because what they were replacing was really broken. And in the US, what Apple Pay has been, it's 7-8 years now, and it's still meaningfully less than 5% penetration in store. People just don't feel the need to pay with their phone. Again, I think the contactless payment rates are up 10x in 2 months.
Wow.
In the United States. So this may be the thing that changes everything. But until we had a pandemic, people were perfectly happy to take their cards out of their wallet and swipe them or insert them.
People are big on the contactless in many ways, more than just in payments.
Yes, we may be. I don't think I'll be shaking anyone's hand for years. So
that's actually like a perfect segue. So a lot of folks are obviously very curious as to what's going to happen in light of this pandemic, and so obviously this is a natural disaster that is causing financial ruin in many aspects, and so I was wondering, if you could walk us through how you see disruptors like Acorns, like the FinTech 2.0s, weathering the storm, given they aren't part of a larger, broader organization like a JP Morgan or Bank of America. And, if there are particular advantages in your own portfolio, why do you see kind of those disruptors either providing downside protection or opportunities for alpha?
Yeah, I think anyone with a big balance sheet heading into a crisis is in trouble. And that's doubly true if you're a small, scrappy, money-losing business. But the banks just announced earnings this week, and they all lost horrific amounts of money in Q1. And that's because people who borrowed money aren't going to pay it back to the rates that were expected, and there'll be lots of insurance claims, and people who are buying real estate are going to make horrific losses on those holdings. So anybody who had a book of business as expressed by a balance sheet of any type kind of wishes they didn't right now, because there can be meaningful impairment. And again, the vulnerable companies who aren't JP Morgan Chase, who don't have trillions of deposits to provide liquidity and don't have trading operations to generate profits during volatile times, will be even more affected. Companies like Acorns, we very deliberately stayed out of lending. And my general view is that, non-bank lending is risky. Basically, you make money during good times, and then inevitably there's a crisis and you get smushed. Sort of like picking up nickels ahead of a steamroller is the metaphor. And so I think we're having another crisis, and companies with balance sheets are going to get smushed. I think companies that don't have balance sheets, that are providing, on balance, digital experiences with no legacy physical footprint, this is probably a tailwind. We've seen at Acorns, for instance, our cost to acquire a customer has gone down significantly. People are still in need of financial services. They are less and less inclined, and as of today, less and less able to go into a bank branch. And so whatever financial services they need, they're looking for online providers. And so that's much more of a fair fight for companies like Acorns. Again, JP Morgan Chase will still get its share of the business, but Acorns, when branches are out of the equation, has a really elegant proposition. So I think that's going to be a tailwind for fintech companies in general, for those who survive this, for those who have the liquidity to get through what I think is going to be a really, really tough patch. I mean, we saw the stock market's bounced back shockingly, but what we saw in the last two crises, that you tend to have this stair-step phenomena where you have your leg down and then everybody accommodates themselves. But then there's more bad things that happen. There's pockets of the economy that are highly vulnerable that we're not thinking about just yet, that are going to have their fireworks, and we're all going to be surprised. And so things are going to get worse before they get better, I'm afraid. I think it seems like a horrible time to be a young person, I know, because you don't have savings and you're worried about your career and people aren't hiring. But honestly, it's a great time to be a young person. I mean, to me, it's like all my companies, right? Like, you're digital. Like you guys don't have.
We're inside kids.
I mean, you don't have the legacy problems that 45-year-olds do. You don't have a mortgage. You don't have a bunch of kids. You don't have all of these fixed costs. You have the freedom and flexibility to travel and find other geographies where there's opportunity. And you have the headset, if you've gone to Williams, to be adaptable and creative. So I encourage you to look at this as a massive opportunity, to where there's been a great leveling. And you had nothing, and you had nothing to lose. At least I did when I was in my early 20s. And so the path forward for you should be clearer if you have the courage and the resilience.
Sure. That's awesome. So, I mean, I'm sure we could talk all day, but we understand you're incredibly busy. So we want to end on this. Every once in a while, you see a bumper sticker on a car that gives you a pearl of wisdom or some sort of truth. As we end, I just wanted to ask, what's your bumper sticker? What do you want to leave the Williams community with? Like, one sentence. It could really be anything.
I'm a big Winston Churchill guy. And to paraphrase, never give up is one of his lines at a moment of adversity when it looked like the UK was going to fall to Hitler. The Battle of Britain was raging in the skies every night. The US was not in the war. France had been demolished. The rest of Europe was falling under Germany's thumb. The UK was this island nation that had lost its entire army nearly in the continent of Europe. And it fell to this one person to get on the radio and try to keep his country fighting. And he said many, many beautiful things, but in the end, he said, never give up. And, the world has a way of trying to convince you that you need to quit, whether it's a global pandemic or much more quotidian challenges that arise in all of our lives. And I learned this, not only from Churchill, but also from my partner, Bo, and from all the great entrepreneurs I work with. One thing they have in common is they just don't give up. They retrench, they adapt, they pivot, but they don't give up. And I hope you all keep that in mind.
It's an awesome message. Awesome message. Thank you so much.